Hi guys, let's go ahead and take a look at our last chapter before our midterm, chapter 5. You can see that we're going to be talking about audit evidence in this chapter. A couple of reminders. You probably saw my announcement now about our midterm. Our first midterm is going to be opened up on September 16th, and then I'm going to, Connect is going to automatically submit your grade into Canvas on September 25th at 11:59. So that gives you a week plus to go through and get into your exam. Once you do get into your exam, please make sure that you're realizing that you have 3 hours to complete that. And so make sure that you've blocked off the appropriate time that once you start it, you'll be able to get through the 3 hours and get through the 30 multiple choice questions. And then once you submit that into Canvas, your grade will appear in the grade book, and then those will be available to you on Monday morning, Sunday night, 11:59 Sunday night. So that's the process that we're looking for in using Connect. The way you access the exam is you go to Assignments in Connect and click on the link there for midterm 1, and that's how you will access the exam. Okay, and obviously this is going to be the first 5 chapters. We're still talking fairly generically now in this chapter, talking about evidence in general, and we're going to see that the auditors perform various procedures. Those procedures provide us evidence. We're going to talk about the various levels of reliability for that evidence, and then we're going to see how that evidence will support the financial statement assertions. And remember, we talked about those assertions way back chapter 1, 2, and we said that financial statements are made up of assertions. And when we get into our detailed accounts, when we start talking about those here after our midterm, we're going to be seeing that at the end of the day, the auditor is simply auditing the assertions and not necessarily thinking, well, you are thinking about the account balance, but your approach is towards auditing assertions and getting the evidence to support that. Anyway, we'll talk more about that when we get into the chapters on the specific account balances. Right now, let's just focus on generically talking about evidence as it would relate to any of the accounts. So I want to go ahead and start us out with some review from chapter 4. And remember, we talked about risk assessment procedures in chapter 4. And the auditor does these to determine further audit procedures, which is going to basically potentially be our testing of the operating effectiveness of the controls, and then we'll always include some level of substantive testing. And we also said that this could be called, I've seen this called the obtaining the understanding phase. And I gave you a mnemonic to remember some of the key parts of that process, in which I say is dire if you forget those. Of course, that doesn't spell dire, but it gives us a mnemonic to remember some of the key parts of this part of the engagement, in which we are going to understand the entity and its environment, including the design of the controls and whether those controls have been implemented. And based on that, the auditor will make an assessment of the risk and material misstatement. If the auditor makes the assessment of risk and material misstatement, we're going to follow this red arrow on to the next page. If the auditor makes the assessment of risk and material misstatement at less than the maximum, then we will go ahead and follow the black arrow onto the next page. And I'm going to see if my pointer is going to allow me to just show you, red arrow here, obviously black arrow here, okay? And so we go over, and if we were following the red arrow, we had assessed our risk and material misstatement at the maximum. The auditor would skip in our further audit procedures, our testing phase, testing the operating effectiveness of the controls, and go directly to substantive testing. The idea being here that if a control is not designed well or a well-designed control isn't implemented, there's no point in the auditor testing the operating effectiveness. Bypass that step, go directly to your substantive testing. If we're in a situation where the auditor assessed the risk and material misstatement at less than the maximum, we would have followed the black arrow from the previous page, and we would have gone ahead then and first tested our operating effectiveness of the controls, and then we move to our substantive testing, and we will determine the timing, extent, and nature of our substantive testing based on the results of our risk assessment procedures and then our testing of the operating effectiveness of the internal controls. So just going over, again, still talking about stuff from last time. You can see that on the next slide in this example, I think we were talking about a jewelry shop or something that we made up as an engagement that we'd be auditing. The auditor wants to keep the audit risk at low. Okay, auditor doesn't want a high audit risk, because audit risk is the risk that we will give the incorrect opinion. We will give an unmodified opinion when we should have qualified. Clearly, we want that to be low. We want that to be 0.05. Sometimes students will say, well, where does that come from? Where is 0.05, 5% chance it will give the incorrect opinion? Well, this has to do with the auditor's appetite for risk. Some auditors may be even more conservative and say that the audit risk can be only 0.01, only 1% chance. That's then, of course, going to drive the amount of testing that we need to do. But an auditor can, decide based on their risk appetite what their audit risk is going to be. Then we will look at the particular account assertion that we're looking at and see if our inherent risk is at the maximum or less than the maximum. In this example, was at the maximum. And in this example, and remember we had that jewelry shop one where we really didn't like the controls, and so we went ahead and we assessed our in control risk at the maximum. And so we would want to lower our audit risk entirely through our substantive testing. We would bypass the testing and operating effectiveness controls. We would get all of our assurance through our substantive testing, and that would keep our audit risk at low if we kept our detection risk at low, 0.05. Remember, we talked about nature, extent, and timing of our procedures. So if we're trying to lower our detection risk by saying that our substantive testing is more, we often say, we really should think of that in terms of nature, extent, and timing. Nature, more effective procedure rather than a less effective procedure. Extent, larger sample sizes. Timing, using year-end testing instead of interim testing. And again, this was stuff that we focused in on Chapter 4. Going over to the next slide, if we're in a situation now where we are believing that our controls do have operating effectiveness, we would assess the risk of material misstatement at less than the maximum, 0.5 in this case, and that was that second jewelry shop where we liked the controls. Now we can accept a little higher detection risk. Be careful, don't ever say high detection risk. It's a little higher. We don't want to say high on that, right? It's higher, but you can see that that's now 0.10 up from our 0.05 from before. And if we accept a higher detection risk, again, substantive testing is down, but we want to be specific. Nature, extent, timing. Nature, we can use a less effective procedure such as using internal evidence instead of external evidence. Extent, smaller sample sizes. Timing, now we can do a significant amount of our testing at interim, although remember, even if we do some interim testing, we will need to do a roll forward and do a little bit of testing to make sure that things haven't changed significantly from the previous, from the time that we did our testing at interim. So we would do some roll forward from our interim date to the year end. So we talked about these things in some amount of detail. I just wanted to review that with you because then you can see that as we make our assessments, now we're going to see how those assessments are going to affect the auditor's consideration of the assertions and the type of procedures that we're going to do around the assertions. Everything we do is around the assertions. And remember, we said last time that our assertions fall in 3 categories. We have our transactions and events, and if we're talking about transactions and events, we are pretty much talking about what our journals for the current year. Okay, those are our journals. Okay, our journals, and that's going to be current year. Okay, that's current year. That's pretty much our journals. Account balances are pretty much going to be our ledgers. Okay, and we're talking about ledgers. That can be all years. If we bought a piece of equipment 5 years ago and that equipment has, 15-year life, then we're going to do procedures to see that that equipment is still being accounted for. The assertions associated with that equipment is still being accounted for properly in the financial statements. And then when we talk about presentation disclosure, we can really think of that about as our footnotes. Okay, and just trying to write on the screen here without having the computer in tablet mode. So forgive me for the sloppy writing here, but that's basically our three categories of assertions. And then you come over and we talk about the specific assertions. Completeness, okay? And completeness results to all three categories, or is involved in all three categories: account balances, transactions, disclosures. All three categories of assertions. So regardless of when we purchased this equipment, we would have to do procedures to see that it is still, if it's still included in the account, that if something still is being used by the company, it is included in the financial statements. Transactions, all transactions that occurred during the year should be included. Disclosures, all the required disclosures, all the required footnotes should be included. So completeness is all three categories. When we take a look at existence, existence focuses on account balance and focuses on the transaction category. So what are we saying here? Well, if we purchased a piece of equipment, as I said, 5 years ago, and it's still showing on the financial statements, the auditor will want to do some procedures to make sure that equipment that was purchased a while back still exists, is still there. So remember, we'll go from the financial statements to the piece of equipment, the supporting documentation, to help us to determine that that equipment actually exists. Transactions, if we're saying that a transaction occurred this year and it's being included, say a sale in the sales journal, the auditor will want evidence that that particular transaction that we're seeing in the sales journal is actually occurred during the year. Rights and obligations, okay? Rights and obligations can get into our various areas here, our account balances. Our account balances, but also to a certain extent our disclosure category, okay? Because when we deal with our rights to a particular asset, there may be some things that we want to disclose about that. So I'm just going to put disclose. Okay, that's our disclosure category of assertions there. Account balance and disclosure category of our assertions. And we do that with the disclosure issue. I think account balance, if we are showing a good example with account balance and why rights and obligations is relevant there. If we're sitting there and we're saying that we have an asset and we may do a procedure to see that that asset exists, we're also going to want to do a procedure to see that the company has, our client has the right to that. They may have rented that asset, so we may be able to see that it exists, but we may ask for invoices, bill of sale, or something to see that they actually have the right to that asset. Disclosure, let's say there's a lien on a piece of property. What's going to happen there? Well, we pledged a piece of property as collateral. We would expect that there would be disclosures around that to show the level of rights that the company has associated with that particular asset. So for rights and obligations, that really falls in the account balance disclosure categories. Okay, understandability classification is clearly what? Clearly, for the transaction category, just making sure that we have classified a transaction correctly, and then obviously disclosures make our financial statements understandable. So remember, we said that's like our footnotes. If we just provided a bunch of numbers in the financial statements, they would not be understandable, right? We have to provide some additional perspective in terms of footnotes, etc. And so that's why understandability and classification would be an assertion that would be relevant, pretty relevant, and particularly closely linked to our disclosure category of our assertions. Okay, so that's just a review of the assertions. We talked about that before. Again, the different categories that they fall into. So it's important for your exam that you know the assertions. Probably won't get too much into questions about exactly what category they fall in, but you should be aware of that. Most importantly, as we move forward in the course, you have to know how to audit these assertions. How do I audit completeness? To make sure the financial statements are complete, I'm going to go from the supporting documentation and take that back into the financial statements to see that the financial statements are complete. And we're going to keep talking about that again and again. Oh, a couple other assertions up here before we move on. Cutoff, okay? Cutoff is only in the transaction category. Cutoff wants to make sure that we have recorded the transaction in the correct year. So we'll look at transactions near year end to see that a transaction occurred, say, in December, towards the end of the balance sheet, didn't somehow end up in the next year's financial statements. Notice I said somehow, I didn't say accidentally, because remember we talked about fraud last time, so we have to consider intent under our professional skepticism and determine and realize that some misstatements could be intentional, which would of course make them fraudulent. So if somehow that transaction slipped into the next year, we would do some procedures towards the end of the year to make sure that we didn't have any of those and the transaction was properly recorded in the current year. Maybe a transaction really did happen in the next year, and again, somehow it got into this year's financial statements. We'd want to make sure that we don't have any of those, so we should look at some transactions just before year end and just after year end to make sure that those transactions that are on the edge of the accounting periods did not somehow slip into the wrong period. Valuation, allocation, and accuracy. This one is in all three categories. So if we're showing something in the account balance, it should be valued correctly. If we're talking about a transaction, it should be recorded accurately. It should, if there's allocation, such as depreciation, that should be recorded correctly. And then this is relevant to disclosures. There's a lot of information about valuation in disclosures, even though we may carry a fixed asset at its historical cost, there may be some desire to report some additional information about the valuation of that. Okay, so that gives us a review of our assertions. So let's just go ahead and see how we will test the assertions a little bit. And again, we're going to get into this in detail by account, and I have this graphic here, but I'm going to do it a little bit differently. Okay, I'm just going to go ahead and say that if my supporting documents are out here, here's my supporting documents, okay, and I go from the supporting document to the financial statements, that's going to be my completeness assertion, right? That's completeness. That's my completeness assertion, okay? If I start, and so why don't we put start here for that example, I started at the supporting documentations, that's my supporting documentation, and then I went ahead and took that back to the financial statements. That would help me with the completeness assertion. I say, supporting documentation if it's a piece of equipment, and I want to make sure that that piece of equipment over there has been properly included in the financial statements. I will see that equipment, and then I will come back to the financial statements to see that it was properly recorded, to see that my financial statements are complete. Okay, if I start at the financial statements, okay, go ahead and I start at the financial statements, and I come this way to the supporting documentation, that's the existence assertion. Okay, that's going to be existence. That's going to help the auditor determine that the existence assertion was fairly stated. Okay, and again, we're saying supporting documentation, but easy to visualize equipment. We see a piece of equipment in the subsidiary records of the entity that we're auditing, our client. So what do? We see, okay, piece of equipment, machinery. We see that there, we go, we tour the facility, we find that piece of equipment. That helps us with the existence assertion. Obviously provides us evidence as the existence assertion. Okay? Now the reason I didn't use the word vouch and trace as you see them here, this is sort of a very very loosely used. It's not quite as strong as you might see in your text, as you might see in some of the slides that we're looking at, okay? And that usually people say, well, vouch for existence, trace for completeness, and that's fine, but I want to make sure you understand the logic and just don't memorize a word associated with the assertion. So, understanding the logic, if we want to make sure that the financial statements are complete, we take supporting documentation, we take the actual equipment, whatever it is in the world that should be included in these financial statements, we start with that and we take it back to the financial statements to make sure that something that should be included is included. Completeness assertion. Okay? If we are talking about existence now, I don't want you to just memorize the word vouch for existence. I want you to understand what you're doing. Okay, so what do? We find the listing of that equipment in the subsidiary ledgers of the company, and then what? Then we go and we actually find that thing to see that it actually exists. So you keep thinking that logic. I think that you're going to be a lot better off in understanding what you're doing with these procedures, particularly when we get later on in some of the other accounts, rather than just memorizing a word. Okay, good. Let's go ahead then, and you can see that we have the assertions here and some sample substantive procedures. And you can see that for some of these, let's see if I can change my pen here back to the highlighter for us. Okay, and you can see that we do what? We start from the source document and we take it through to its recording in the financial statements, right? That's how you test completeness. Existence, what do? We go ahead and we will start from the financial statements and take that back to the supporting documentation. We're going to talk about confirmation with third parties here. This is the classic step for existence, where the auditor will go out to a third party and ask them to provide support for whatever the entity is reporting in their financial statements. For example, accounts receivable. We see an account receivable listed in the subsidiary ledger. Bob Jones, say, has purchased something from the company and they still owe us money on it. So there's an account receivable. So what are we going to do? We're going to send a letter to Bob Jones, a third party, and say, do you owe? And we'll talk about how to handle confirmations. We may ask him to tell us the amount that he owes, or we may say, do you owe $25,000? We'll tell him the amount. We just want him to check off on that. Regardless, we are getting evidence from a third party, confirmation about the existence assertion, because we have done what? Said, here's something listed in the financial statements. Now we're asking someone to document to us that indeed they do owe that $25,000, whatever it is. Classic existence step, confirmation. Okay? Cutoff procedures. We said cutoff, right? We talked about cutoff as an assertion, and that's where we look at transaction close to year end to make sure that transactions that are on the cusp of the year haven't somehow slipped into one of the years or the other. Okay? Rights and obligations you saw there. And we'll talk more about inspection and how that's going to help us to understand whether or not the entity has the appropriate rights to that. We're looking for an invoice if they're saying they own that, etc. Okay? Understandability, classification. Okay? Review related disclosures for compliance with GAAP. Typical step here is to have a GAAP disclosure checklist, and we'll go through that and make sure that all the appropriate disclosures for that entity, their industry, etc., have been properly included in the financial statements. Valuation, allocation, and accuracy. Okay, and I want you to always think about this category, these assertions here. Think of these assertions here as, and I want you to think of those as, try to get my pen up here if the pen will turn the right color for us, okay? I want you to think of those as accounting estimates. Okay, these are management estimates. These are management accounting estimates, right? I mean, do we really know what the value of a particular item is, what the value of our accounts receivable is? For example, even though that person checks off, I owe $25,000, do we really know if that person's going to be able to pay? us or not? No. So what would management do? They would probably have an aging schedule, and if that person starts to fall behind, they start to fall delinquent in their payments, management is going to put additional amounts in the allowance for that individual. But it doesn't mean that the exact amount that they put in the allowance for doubtful accounts for that individual is what they are actually going to collect. So valuation is a management estimate, and remember, we do our procedures, our audit procedures, per the assertion. So all of these assertions could just relate to one account, accounts receivable, and we're going to do different procedures for different assertions. And in the case of valuation, what we're going to do, the classic step here, is recalculate. Okay, we're going to recalculate. We're going to come up with our own independent estimate by recalculating and seeing that our estimate that management's estimate seems reasonable after we've done some independent recalculation. Okay, so these are our primary assertions here, giving you an idea of the different audit procedures that we would perform. Now, right now, some of this stuff looks a little foreign to you. You know, what exactly is a confirmation? What exactly are you talking about when we say recalculate? Well, that's the subject of this chapter now, is we're going to start to put some words around the type of procedures, the type of evidence that the auditor will get in order to support the financial statement assertion. So for the most part so far now for Chapter 5, we reviewed some things, and that's probably helpful because our midterm's coming up here at the end of this week on the 16th, although you'll have to the 25th to turn that in. But now we're going to start to get into some new material for Chapter 5. So let's just go ahead and take a look at how we're going to use the assertions to determine the audit procedures. And remember, we make our assessments of risk. We make our assessment of risk and material misstatement, and we're going to respond at the assertion level. Okay, we're talking about the assertions, but there's also, remember, an overall financial statement level risk that we consider, and we will respond to that. So if we've assessed the risk and material misstatement at the overall financial statement level, and we've made the determination that our risk and material misstatement is high, for example, we will communicate to the team the need for professional skepticism, and we'll make more of an emphasis out of that if we've seen some of the fraud risk factors that we talked about in the last chapter, Chapter 4. Assigning staff, maybe more experienced staff will be assigned. We will increase the level of supervision, okay? And these sound familiar to some of the things we said that we would do in response to a high risk and material misstatement due to fraud, but we could also respond appropriately this way if we thought there was a high risk and material misstatement due to errors. Okay, so we respond at the financial statement level, but then we also respond at the assertion level. And when we're responding at the assertion level, we're saying to ourselves, what could go wrong? Okay, and when we say what could go wrong, the what could go wrong is the potential misstatement. Okay, so you come over and you take a look, and you probably remember this chart from the previous chapter where we've gone ahead and in our obtaining and understanding phase during our risk assessment procedures, right? I have that highlighted up here. Okay, for our risk assessment procedures, also called obtaining the understanding phase. That's when we're understanding about the internal controls and making our assessment of our inherent risk. That's where we're thinking about, well, what would be the potential misstatement for this account? And then we look at our control risk. And in this example, remember we went through last time, we said, well, there was a potential that there would be a misstatement that the good has, they've recorded a sale the client has and a receivable, but the goods were never shipped. So how do we find out? And notice, guys, we're lining this up with the assertion. Okay, this is the occurrence assertion. The goods were not shipped, the sale did not occur, the receivable does not exist. So what happens? The control technique that the company comes up with is they have the same person who booked that sale also calls the customer, not booked the sale, but made the sale. We would want a separation between our sales folks and our accounting, but the person that made that sale also follows up the customer with satisfaction of goods. Well, in this example, I'm saying I don't care too much for this control, and I assess my risk and material misstatement, at high in this case because we are dealing with sales. Okay, sales is an area where we're concerned about overstatement, the existence assertion. And so we turn around and we say, well, if that's the case and this control is not effective, we had assessed our risk material management statement at high. And one of the key things is we don't like the separation of duties. And we're not happy with the separation of duty because the same person that made the sale also is the person that is calling the customer up. Well, they may be the ones that are trying to increase the sale so they can get a higher, commission or whatever. So we don't like the separation of duty. So we don't like the design. We also didn't feel that that control had been properly implemented because, and remember, I said that when we do walkthroughs, that's really in the obtaining the understanding phase, and we're really looking for implementation, and we didn't feel it was implemented because the staff didn't seem to fully understand what they were doing. So if that's the case, we bypass the testing of the operating effectiveness of the internal controls, and we go directly to our substantive testing. And notice I'm talking here about confirming the accounts receivable. Confirmation is the classic step for our existence assertion. Okay. Now, I also did an alternative example. It was still the same account, still the same potential in the statement, but now I had assessed the risk and material misstatement at low because I liked the design, and I changed up the story here. That now we have the internal audit staff involved in these follow-on calls, managers documenting, logging the calls, etc. The board of directors is concerned and looking for this control, etc. Okay, so we go ahead and we assess the risk and material misstatement at low. Now we have to actually conduct our control testing, and if our control testing shows the control has now operating effectiveness, then we can lower the timing, extent, and nature of our substantive procedure. So our smaller sample sizes here, and we're in pretty good shape here in terms of our lowering, accepting a little higher detection risk, and getting the evidence we need to support our opinion. Okay, so this is sort of tying some of the things together now: the risks assessments, the assertions, and then how that determines our further audit procedures. Okay, so now we're going to start to take a look at some really still definitional things here as we start to go through and understand more about our evidence that's going to be used to support this process. Okay, so let's just go ahead and take a look at this question. And we say, in determining whether transactions have been recorded, that's what assertion? Think about it for a second. Determining whether something has been recorded, that's the completeness assertion, right? If something has been recorded correctly in the financial statement, has it been recorded? That's the completeness assertion. And so we would start with the original source document. And you saw that in the little graphic that we had earlier, and also you have seen this question here from your quiz that will help you remember and start to get a handle on how you audit the assertions. Let's try another one. You are auditing a store that sells merchandise. Some of the store merchandise is held on consignment. Which account a balance assertion for inventory should you be most concerned about? Well, if some merchandise is held on consignment, okay, that means that I am holding items in my premises that don't belong to me. I'm holding them in my store, but if I sell that item, and maybe the true owner will let me keep a small percentage of the sale, but I'm going to remit the probably most of the proceeds. Maybe they let me take, for example, 5%, but 95% of the proceeds I will turn over to that owner of that inventory. So if I'm preparing the year-end statements, if management's preparing the year-end statements and I'm auditing those, I would have an expectation that they have not included those items that they hold on their premises on consignment. They do not include those in the inventory balance. So even though they physically have possession of them, they don't have the rights to that. So that would be the assertion that we would be most concerned about for consignment, because even though they may have those goods on their premises, they should not include them in their inventory balances. Remember, we said that rights and obligations relate to account balances as well. They should not include them in their account balances because they do not have ownership of that particular asset, in this example, inventory. Okay, let's go ahead and take a look at another one. Which of the following procedures would an auditor most likely perform to verify management assertion of completeness? Now here we say compare shipping documents to related invoices. Okay, now that's the correct answer, but let's just visualize a little better what's going on here. So what happens? I have my sales journal, right? Let's just look at my sales journal. Say this is my sales journal. Here's my sales journal. And of course my sales journal, I'm not going to get into the basics of accounting. The sales journal supports my ledgers, my subsidiary ledgers, and the ledgers support the financial statements. But now I'm doing my audit procedures here with the supporting documentations and the books of original entry, my journals, etc., right? And so what happens? I'm sitting here and I have invoice 1, I have invoice 2, I have invoice 3 sitting in my sales journal. Okay. Now over here I have what? I have my actual invoices. Here's my actual invoices, and I have invoice 1, invoice 2, invoice 3. Okay, you can see I'm not a real good drawer, but I guess these are documents. Okay, and let's say this is not invoice 3. This is invoice 17. Let's say I don't want that to. Let me erase that. I don't want that to be 3. You'll see why in a second. Okay, hang in there with me on this example. Okay, so what happens? We're sitting here and this is invoice number 17, let's say, and they have other invoices in there. But I'll just show you what's going to happen with the 17. Now, I would also have shipping documents to prove that those goods were shipped. Okay. And I have those different shipping documents here, 1, 2, 3, whatever. 17 is there. Okay, 3. And I might have some customer orders. Okay, another document. Let's just deal with the shipping document since that's what this question's asking us. Okay, so what does the auditor do? The auditor sees this shipping document. Hey, goods were shipped. If goods were shipped, the idea is that I sold that to somebody. That's why I shipped that, right? Then what? Then I go ahead, I find the related invoice, and I take that back and see that that's properly recorded in the sales journal. I just proved the completeness assertion. That's completeness because I started with the supporting docs. I'm just going to put complete. Okay, it's completeness. Okay, but I'm just going to put complete. I started with the supporting docs. These are my supporting docs over here, and I took it back to the financial statements, right? Now you're wondering, okay, what is this 17, John? Well, let's say I tried the same procedure with this number 17. I take the shipping doc, I find the invoice, and I try to take it back. Is it there? No, it's not. So the auditor does what? The auditor identifies a misstatement in the completeness assertion by starting with the supporting documents and trying to take that back to the accounting records, in this example, the sales journal. Now, you can probably imagine then now if we were to go the other way. Okay, let's see, maybe I can use green for this one. Okay, if I were to start here, say with this sale number 2, okay, the sales journal entry number 2, and I come back over here and I find the actual invoice and the actual shipping document, well, now I just proved what? I just proved existence, didn't I? Okay, I'm just going to abbreviate that exist. I have just found the existence assertion. I proved the existence assertion. And if I took this one and I tried to find it, well, it's not there. And that might be the point where I say, excuse me, management, what happened with this number 3 here? And they'll say, oh, that was Bob. He used to make that mistake all the time. We let him go. Okay, well, Okay, maybe it's an error, but my professional skepticism will say perhaps this was done intentionally, perhaps it's indicative of some sort of fraud, and I might want to take a good look at that, okay, and compare with other things that I see. Maybe now the fraud risk factors are starting to emerge. And remember, fraud risk factors are up in the general part of our auditing standards, and that's the AICPA's way of telling us you need to think about this throughout the engagement. And so at this point I might say, well, before I didn't think I see the fraud risk factors. Now I'm seeing things during field work that are giving me concern, and I'm going to respond to that, maybe increase my sample size, etc., to lower my detection risk, because I'm seeing the fraud risk factors are driving up my risk of material misstatement. Okay, but that was last chapter. Here we're seeing now how we have to understand the assertions, okay? And in this example, since it was completeness, right, I was taking the shipping documents, finding the related invoices, and of course making sure that the invoices are properly included in the financial statements. That's sort of a basic step, that the invoices are representative of what's in the sales journal. But again, I would have to do something to make sure that the invoices that I would be matching the shipping documents with in this example have been properly included in the financial statements. If you pull the sample from something that's not properly included in the financial statements to begin with, you're going to have an issue. So I would always make sure that there's a reconciliation between the documents I'm testing and the financial statements, and then I can start to do these procedures, starting with shipping documents, and then finding the related invoice, and of course, again, those invoices I would have already checked to see are properly included in the financials. Okay. Okay, so let's go ahead and continue with this next question, and we're still dealing with financial statement assertion in this one. This one's a little bit tougher, in that they're actually asking us to do sort of a higher level thinking, evaluation type analysis on this one, which is something that we're seeing more and more in, for example, the CPA exam, etc. So this is a good question for us to practice with. And they say, based on conversations with owner management of an audit client, the auditor ascertained that the company's primary motivation is to avoid paying income taxes. Based on this motivation, what account and balance assertion for ending inventory will the auditor most likely be concerned about verifying? And so let's go ahead and let's take a look at this one. Let's get the pen to help us with this. Okay, so what happens? We're sitting here and we have our beginning inventory, right? We have our beginning inventory, right, whatever that is. And then we have our purchases for the period, okay? Whatever those are. And that gives us our goods available for sale, obviously. Okay, just using some basic things you remember from your introductory to accounting, right? Now what happens? Once we have those goods available for sale, then we're going to go ahead and we're going to subtract our ending inventory. Okay, whatever that is. And that, of course, is going to yield our cost of goods sold. Now what happens? If the client is interested in avoiding taxes, what they would do is they would understate. They're going to understate. Okay, that says understate. They're going to understate the ending inventory. If they understate the ending inventory, we're going to have a smaller subtract from our goods available for sale, and thus we'll have a larger cost of goods sold. Larger cost of goods sold, what happens? Lower net income, lower taxes. Okay, so if we're worried about understatement, then the assertion that we're concerned about is the completeness assertion, because they're leaving certain costs out of the inventory, certain items or whatever out of the inventory. That's going to bring down the cost of the ending inventory, and that is then going to overstate cost of goods sold, understate net income, understate taxes. Okay, so again, the takeaway here: what assertions? Do we know how to audit the assertions? But also, how does that impact, the timing, extent, nature of our audit procedures? So again, everything flows from the assertions, including our internal control evaluation, including how we're going to be setting up our substantive procedures. Okay, now of course we are going to set up our evidence so that it is supporting our financial statement assertions, and then that evidence is there to support our opinion. So we're going to talk generically about evidence here. Of course, evidence will be in support of our various accounts and the assertions within those accounts, but at a general level, as we consider our assertions or our evidence to support our assertions, we're going to be thinking about the sufficiency and the appropriateness of evidence, and then we're going to evaluate that evidence to support our opinion. And when we talk about evidence, I think that we tend to think of it in terms of our records of initial entries, etc., our contracts, our invoices, like we were talking about earlier. But remember, in that example, we just didn't have the records as support. We applied audit procedures to those records to enhance that evidence, to corroborate that evidence. So it's not just a matter of having these evidences that you see on the screen. It's also the auditor is going to provide their own analysis to that to help support that evidence. And the more of that evidence that is falling into the realm of auditors' direct personal knowledge, the more reliable that evidence is, the more it's falling towards the bottom of the reliability or persuasiveness of the evidence inquiry, the less the quality is going to be and the more quantity we'll need of that evidence. So let's just go ahead and take a look at the next slide, and you can see that we're talking about the quality of evidence. And if we have a higher quality of evidence, then we will not need as much quantity. If we have what? If we have a lower quality evidence, then the quantity of evidence to support a financial statement assertion is going to have to be more. But we can't forget that our risk of material misstatement and our assessment of that, the greater the risk, timing, extent, and nature of our substantive procedure, the larger is going to be the need for our quantity of evidence as our risks go up. So we're sort of balancing between the quality and quantity, and they tend to be trade-offs of each other, driven by our risk of material misstatement. Okay, so when we think about the evidence, we think about various types of evidence that we're going to look at, and we're literally going to have a hierarchy as to the persuasiveness of that evidence, and then we're going to see that as we look at the persuasiveness of the types of evidence, we're going to then understand something about the nature of audit procedures that will allow us to gather the evidence that falls into these different categories of persuasiveness. So again, higher level persuasiveness, a higher quality of evidence is things like inspection of a tangible asset, reperformance, recalculation. We're going to see that those types of procedures fall into the category of auditor direct personal knowledge, and we're going to see that observation and inquiry are a little bit lower on the food chain of procedures that would generate evidence. So when we talk about the hierarchy of evidence, auditors' direct personal knowledge is the most persuasive. Okay, so as we look at these, this is most persuasive. Okay, most persuasive. And when we come down and we're talking about oral evidence, that is going to be least persuasive. So we're going from most persuasive to least persuasive. Auditor direct personal knowledge. What sort of procedures would we be considering auditors direct personal knowledge? Recalculation, inspection, direct inspection, say, of property, reperformance of an internal control. This is considered direct personal knowledge. Okay. Now, we could also inspect a document, and if we're inspecting a document and that document that we're inspecting is an external document, that is going to be more persuasive than an internal document. Even though we may be inspecting both, this direct communication between the auditor and a third party, we often call that confirmation, is a good example of external evidence. So we have external evidence and it's direct, such as a confirmation. That's going to be more persuasive than indirect external evidence. What do you mean by indirect, John? Well, if our client receives a bank statement from the bank, that came externally. But if they first hold that and then provide it to us, then that's going to be considered indirect. Still external, still more persuasive than, say, an invoice that the client generated, okay, but not as reliable as some sort of direct external evidence, okay? So, again, most persuasive, auditor's direct personal knowledge about something, inspecting a piece of property, reperforming an internal control, recalculating an estimate like depreciation or the amount that goes into the allowance for doubtful accounts. These are auditor's direct personal knowledge. External evidence is going to be second tier. Internal evidence, oral evidence, inquiry, in other words, is the least persuasive, and you would typically want to include, combine your oral evidence with other forms of evidence that we see on this hierarchy. Okay. All right, again, for internal controls, and we talked about this last time, but internal controls type procedures, we call reperformance, really is falling into the category of the auditor's direct personal knowledge. For reperformance, this is relating to internal control, and the auditor would think that that is the most persuasive. Then what? Then observation, witnessing an individual as staff doing something is the next persuasive. Inspection is going to be an instance for inspecting an external document. That's more reliable than an internal document. And you can see again, inquiry is on the bottom of the food chain here. So this is giving you a hierarchy with internal control on the mind. And what we're dealing with here is that the lower the assessed level of control risk the auditor is thinking about, the more of the reperformance type, higher quality evidence that we would be looking for, and less of the inquiry. If we're using inspection, then we would expect the volume of evidence to go up. So again, it's that sort of trade-off between quality, quantity, and how much we're going to be relying on the controls to lower our risk of material misstatement, and then again, we will then use that to determine our risk of material misstatement, and then use that to determine our timing, extent, and nature of our substantive procedures. Okay, so most reliable, reperformance, that's falling in the category of auditor direct personal knowledge. Confirmation, I'm thinking, is second on this list because it is external evidence, but again, auditor's direct personal knowledge would trump that. Observation, inspection, better than inquiry, but certainly lower than a reperformance. Taking a look at the next one, which of the following is a least persuasive type of evidence? And we say documents mailed outside to the auditor. Just looking at that first one there, well, that's external evidence, that's direct. Correspondence between the auditor and third parties, that is external, that's direct. Computations made by auditor, direct personal knowledge. Copies of sales invoices inspected by the auditor, now we're doing what? We're doing inspection of internal documents, and so that becomes less persuasive. Okay, we've seen already the following most reliable. We've seen that question is reperformance. That question's in there twice for some reason. Take a look at this one. Which of the following statements concerning audit evidence is correct? A company's accounting data cannot be considered sufficient audit evidence to support the financial statements. In other words, alone. We take those accounting records that we saw on that other slide, but again, as I stated, the auditor applies procedures over there that will help corroborate that evidence that we've seen in the form of these financial statement documents and financial statements, the ledgers, the journals, the supporting documentation, etc. Okay, good. So when we think about audit procedures, we can put them broadly into three categories. Okay, and it's not like the different audit procedures are as exclusive to any one of these. Okay, but we can do risk assessment procedures. We've talked about that. That's where the auditor is going to end up making the assessment of the risk and material misstatement, right? And we could observe, we could inquire, we could inspect documents, we could do reperformance as part of helping ourselves to obtain the understanding. Then what? Then we will do a test of controls if we have assessed the risk and material misstatement at less than the maximum. And again, we could, as a test of control, do some reperformance. In fact, I think that's more realistic as being a test of control. We could inspect documents, but now, instead of doing a one-day walkthrough and obtaining an understanding, remember, we're pulling a larger sample of transactions, and we're going to use that sample of transactions to help support that lower assessed level of control risk. Again, the lower we're trying to get that risk, the more reperformance type evidence we're going to need, the larger quantity of evidence that we're going to need. So if we felt that we really needed a low level of control risk and wanted to be absolutely convinced that that control had operating effectiveness, we would pull a larger sample to help support that lower assessed level of control risk. Okay. By the way, some of the procedures that we perform as a risk assessment procedure could also spill over and provide us evidence as to the operating effectiveness of the controls for the test of the controls, even though they weren't originally designed to do that. For example, if we do a walkthrough and we do a reperformance, well, we can use some of that understanding, direct personal knowledge, to help say that we have this sufficient evidence to lower our control risk below the maximum. But we would still have to do something. When you look at do a walkthrough, that means that control worked that day. It doesn't mean that that control had operating effectiveness throughout the year. That's why we typically pull a sample, and we'll talk about sampling in a later chapter. That's usually why we take a sample of transactions that happen throughout the year, inspect documents associated with that, and of course those documents are going to be internal because we're talking about internal controls, but we would apply a procedure inspection, and that procedure then would help support that lower assessed level of control risk. And of course, that's if we have assessed the risk of material misstatement to less than the maximum. We're going to test the operating effectiveness of the controls. We will always have to do some of our substantive procedures. So let's just remind ourselves what we said a little while ago. Always have to do risk assessment procedures. Always have to do substantive procedures, right? And then sometimes we will test the operating effectiveness of the controls if we have assessed the risk of material misstatement at less than the maximum. And then again, in all these categories, we'll see on the next few slides some different procedures. In all of these categories, we would do the different procedures. For example, substantive procedure, again, we can do inspection, we can do inquiry, but now we're inspecting for things that will help us to detect the misstatement as opposed to detecting whether or not the control had operating effectiveness. So we might look at the actual calculations on a document, or get a sense, and when we inspect the actual property, we're looking for obsolescence or looking for damage or something like that that will ultimately affect the dollar amounts that are being recorded for those assertions. And again, everything flows from the assertion. All the audit procedures flow from the assertions. Okay, so enough of that. Let's start to take a look. What are some of these procedures? Okay, and we give an example here as to how you would do procedures that, and we're focusing on the audit program. By the way, there must be a written audit program. That says written. Written audit program has to be a written audit program on all engagements. And we start talking about, of course, the assertions, and then we line up the procedure with the assertion. And here we're talking about a substantive procedure. This is confirmation. This is the auditor obtaining external evidence that is going to support the assertion existence. So we're going to pull from our client subsidiary ledger a sample of customers, send those customers a confirmation letter, getting external evidence that's going to come directly back to the auditor to help to confirm the existence assertion. Okay, so it all flows from the assertion. Audit procedure. Confirmation is an example of audit procedure. It is an example of external evidence that the auditor would want if we were trying to lower that risk of material misstatement by lowering our detection risk, because we're getting a piece of evidence that is higher on the food chain in terms of the hierarchy that we saw a minute ago. Valuation allocation. Okay, we say test the adequacy of the allowance for doubtful accounts. This is a recalculation, and we're going to see recalculation called out in a couple of minutes on another slide, but recalculate is auditor's direct personal knowledge. So I'm looking at this list. I'm thinking this auditor is getting some pretty nice evidence in support of the accounts receivable. We've got some external evidence, we've got some direct personal knowledge we've acquired through our procedures, confirmation, and recalculation, even though they didn't call it out as such on this slide. Okay, good. Come over and let's take a look at inspection. Okay, and here they go, saying, well, you have the records, but you have to do more than just the records. You have to corroborate that. You have to apply procedures to that. In this example, inspection. And with the inspection of the documents, we're actually doing a directional test. And we talked about this earlier. And again, I don't like just remembering a word. If we are trying to test what the existence occurrence assertion, we start at the accounting records, and then we do what? We go back and find the documentation, or it doesn't even have to be a document. It could be the actual physical asset, right? Start from the accounting records, go find the asset. That's auditor's direct personal knowledge now, where we're going to be inspecting that property as we go through and perform our audit procedure, right, which is inspection, which falls in the category of auditor's direct personal knowledge, right? Coming back, start with the source document. I don't know why I have to draw the line again. It's already there, right? But theirs looks much prettier than mine. But what I wanted to put here is what? Here we start at the source document, and we take it back to the financial statements. Again, I don't like memorizing vouch and trace. Then you come back to the financial statements. That is a completeness test. So if we're seeing here, and I think we had the example that it was, I forget which one we did the completeness test on. Remember, we had document number, invoice, shipping document number 2, invoice number 2, and we took it back and we actually saw that one. I think in the other one we said, oops, we had 17, and when we tried to come back, 17 wasn't there, and so that would help us to find a completeness issue that it should have been included. I shouldn't put an X to it. It should have been included, but it was not. We didn't see it there, I guess, is why I'm putting the X, and so we would say, how come? And we would expect management to include that transaction appropriately. Okay, so we talked about that. That's called directional testing. That's falling in our category of inspection, which is auditor's direct personal knowledge. Coming over, inspection again. Now, it doesn't have to be a document we inspect. It could be the actual asset itself. Observation, a little lower on our food chain. Okay, now we're getting into what? More of what we've already called that an example of it's still the auditor's direct personal knowledge, but in terms of looking at the internal control, it is not as effective as our reperformance. So remember, we have the broad categories: auditor's direct personal knowledge, external evidence, internal evidence, and then oral evidence. And even though observations falling in direct personal knowledge, it's not as good as actual inspection, or in the case of a control test, reperformance. But it still is considered auditor direct personal knowledge. Inquiry, okay, inquiry is going to be an audit procedure. Very low down on the food chain. It's an oral evidence, right? But the expectation is that we would combine that with some of the other forms of evidence. Confirmation, this is external evidence. Confirmation is the classic test for existence, okay? And again, we're going to use this confirmation to get external evidence, and we do this fairly routinely with accounts receivable. And you come over to the next page, and we should mention account receivable there, but also, you could confirm a bank balance directly with the bank, or you may obtain something called a bank cutoff statement, which comes 10 to 15 days after year end, in which you're going to be asking the client's bank to confirm outstanding checks to see that those have cleared. You're going to ask them to provide you, they call it a bank cutoff statement, that and they'll just give you the information, but then you'll be checking to ensure that the outstanding checks have cleared the bank, deposits in transit have cleared the bank, that sort of thing. But this would be considered external evidence confirmation directly with the auditor. And we'll talk about some of these others later. We don't need to get into all this detail, just knowing that confirmation is a form of external evidence. Pretty reliable set of evidence for us. Okay, reperformance, again, that is sort of the cousin of recalculation. Recalculation, we saw that was used for, and when we do recalculation, we mentioned this earlier, this is for accounting estimates, right? For accounting estimates. Okay, accounting estimates. Best thing we can do is recalculate. Okay, auditor direct personal knowledge, very high level of evidence, gets us to understand some areas where management may have certain subjectivity, and so we go ahead and we recalculate. Reperformance is really the cousin of recalculation for our internal controls, really. When we get in and we reperform the control, remember for our internal control, that was towards the top of the chain there, that little pyramid that we had up there. And so for internal control, we're probably talking reperformance is the best. For our substantive testing, our recalculation is in the category of direct personal knowledge, and that's a pretty high level of evidence. Okay, analytical procedures, we're going to talk about those. Scanning documents, judgmentally looking for things that seem unusual to us. We see an unusually large transaction by scanning. We might want to take a look at that particular transaction, try to get behind some of the details. Okay, analytical procedures. As we have said previously, we must do analytical procedures during planning. These are at a high level. We have to do this, high level. Compare last year's revenue to this year's revenue. Compare actuals to budgets, high level. Okay, final review. We will do that at the end of the engagement, okay, and this is at a high level. Again, trying to make sure that there was no unusual adjustments that were made towards, just before they issue the financial statements, so the auditor will do another round of analytics. As a substantive procedure, we do not have to do an analytical procedure if we don't want to, but there are many times where analytical procedures will be appropriate, either because we don't think that there will be a misstatement we won't detect a misstatement if we were to look at a test of details. In other words, we think our risk of material misstatement is low, or if there is not the appropriate evidence to allow us to sit there and do a test of details. Okay, and so when we sit here and we do our use our substantive test as our analytical procedure substantive test, we tend to do that at a disaggregated level, okay, level of detail. Okay, so you can see down here we're going to use our analytical procedure as a substantive test when we start falling into these situations here where we have we feel that there is not going to be misstatement from an examination of the detail, or where the detail is not available. Okay, and so let's just go over and let's take a look at our more information on analytical procedures. And we say that we must do them in planning. So in our risk assessment procedures, we're going to go ahead and do some analytics. And through our risk assessment procedure, we do an analytic, and that then calls out to us, uh-oh, we have a problem because we see a big increase in revenue. What's going on? We'll do an analytical procedure in our planning. We will do a final set of analytic procedures, again at a high level, and if we want to, this is optional, we can use our substantive analytical procedure as our analytical procedure as a substantive test, okay? And we would do this optionally. So you take a look at this next one, and they talk about when you would do your how the different types of procedures that we've talked about, different categories of procedures, will give us the evidence that we need. And notice that we're saying that our risk assessment procedures will provide us some evidence, and really they provide us an understanding more than evidence, but it doesn't mean that they don't provide us any evidence about the financial statement assertions. For example, if we do a walkthrough, even though that is falling in our obtaining the understanding phase, it is a procedure that we do to obtain an understanding. If that this process provides us some evidence to help support the assertions, we don't have to ignore it. For example, if we were going to look at 50 days worth of transactions and we do our walkthrough one day, we can combine that then with the documents that we inspect covering, say, another 49 days if we wanted a total of 50 days. So it is providing some evidence. I think maybe that's why they made the lines here a little lighter. Then what? Then we can go ahead and we can have our substantive procedures, and they can provide us evidence, and then our test of details. And again, substantive analyticals are something that is optional for us to do. We don't have to do these, and we would do them if what? If we believe that there's no detail available, or if we believe that we would not identify material misstatement if we had done a test of details. In other words, our risk of material misstatement is low. So you come over and we talk a little bit about trend analysis and how to use that. Before we do, though, just remember back to the washing machine revenue example we had. So let's just go ahead and recall that before we get into this ratio, because I just want to go into this example about how we would use washing machine, how we would use a substantive analytical to help us with washing machine revenue. So let's say we have a laundromat that we're auditing, and they have washing machine revenue, and we're thinking, how can we get satisfied that they have the correct washing machine revenue being reported? So we would go ahead, and we don't have to use accounting data only. Okay, you can use you can use performance data for your analytical. And so let's say they use 10,000 gallons of water, and we determine that it's 2 gallons per load of laundry. Well, that means if we took these 10,000 gallons and divided it by 2, that means that we're going to have not 10,000 but 5,000 loads. And if they were charging $3 per load, that's what? $15,000 of washing machine revenue that we would expect the client to report. Okay? Now, we take that $15,000, I'm just going to write it over here to give you more room. Okay, we take that $15,000, and it doesn't have to be exact. We say plus or minus, say, 20%. And you say, where do you get 20%? That's what my office uses. Different companies, different audit firms would use different amounts. But that means that this could be as high as 18, and there's no reason I'm writing it under our control testing risk assessment procedures. I probably should be writing it under here because it's an example of using a substantive analytic, but I just needed more room. And then what? And then it's as low as 12,000. Well, let's say that the client had reported, and we'll use a different color to show what they're actually reporting. Let's say the client had reported $17,000. Well, if the client reported $17,000 for their washing machine revenue, the auditor is probably satisfied now that we have the evidence through a substantive analytic to support the occurrence assertion that this client, reported their revenue correctly. We tested that assertion through the analytical procedure. Now, if the client was sitting there and showing me, I don't know, $23,000, I'm just making this up. $23,000 is the washing machine revenue. Well, now we'd say, well, wait a minute now. We were willing to go up to 18 with you. Why are we down here now, up here, way up here at 23,000? This is the auditor asking that question, okay? And so what happens? Management explains to us that some of their customers don't want their laundry washed by city water. They want to use rarefied water from the mountains for that, and that water has to be trucked in. We say, okay, we didn't know that. We add that to our analysis that explains our difference between our expectation and what the client put down, then that could be explainable. And we might move a little more towards a test of details now as we ask to see those trucking water bills. Okay, if they didn't explain it, we're going to have to do something else to be satisfied that they have reported that correctly. Okay, good. Okay, so let's go ahead and continue on. I apologize for that little quick change there. I just wanted to make sure I was still recording this, so I see that I am, so I'm going to go ahead and continue. Okay, and let's go ahead and let's take a look at our type of analytical procedures. Okay, and we can do trend analysis longitudinally year over year to see how things have been changed this year versus last year. We could use a reasonableness check, and I guess I want to see if I can get this off. Say no to that. I don't want to delete that, and away that thing goes now, so you don't have to see that part. Okay, ratio analysis. Ratio analysis is going to be useful to us, and that it is going to allow us to compare our client to other clients. We could do trend longitudinally year after year. Why is revenue increasing at a certain rate that's not meeting our expectations? Reasonable analysis is the type of thing that we just looked at with that washing machine revenue. It's reasonable to think that there's going to be a cap on the amount of washing machine revenue based on water usage, right? Okay, the more water you use, the higher. The less water you use, the lower. That's a very reasonable analysis, right? Okay, good. So you take a look, and again, when we look at this, we can use operational data to come up with our estimates. That's going to be non-financial. Okay, non-financial data. Okay, data is okay to use for these. Financial, such as comparing budgets to actuals, industry publications, seeing how our client stacks up against the industry that they're in. So that's where we will then come up with the tolerable difference, and in our example is plus or minus of our expectations, and then we went from there, and where we did see, and notice we were down a disaggregation when we did that. This laundromat has different products, the washing machines, the dryers, the soap dispensers, whatever. All of these things are different product lines, and we just did our test at a disaggregated level at looking at just the washing machine revenue, okay? And so we go ahead and we would consider that plus or minus 20%, and then we would get an explanation for the differences in our little example. They explain that to us. Okay, and so we found out about the water trucking bills. We investigated that, and if that explained the difference, fine. If not, you've got to keep going until you get an explanation for those differences. Okay, ratios are going to be helpful because it's going to allow us to compare our client to the industry. And you know the different types of ratio: current ratio, quick ratio, all being short-term liquidity ratios. Activity ratios, receivable turnover, that might help us to analyze the allowance for doubtful accounts. Inventory turnover might help us to determine if there's some sort of obsolescence in the inventory. So if we do this as a planning analytic, now if we're seeing a slow turnover that doesn't compare well to the industry or the type of product that they're dealing with, we're going to go ahead and know that we need to take a better look at inventory to see if there's some obsolete items in there. So we can use them, again, planning phase. We have to use them in planning phase. We can use them as an analytic, and we will use them in the overall review phase. Okay, and then profitability ratios, you can see some of those. And I'm not going to get into the specific ratios in our questions, but I do want you to understand that ratio analysis is part of your analytical procedures, part of your tools that help you to do your analytical procedures, and they provide a good comparison against industry. Remember, we said that's one of the type of analytics we might do. Okay, and you have your coverage ratios as well. Okay, let's go ahead and let's take a look at a couple of questions. Which of the following are ordinarily designed to detect possible monetary errors? And the key phrase here is monetary. The key word, I guess, is monetary, because these three incorrect answers are all considered control tests. Only the analytical procedure falls into the category of potentially being an analytical procedure, and so that's why that's the right answer. Okay, taking a look, auditor decision as to whether to apply an analytical procedure as a standard procedure or to perform a test of details of transactions. They didn't say details, but that's what they meant. And it has to do with what? The relative effectiveness and efficiency of the test of data. The available of data aggregated at a high level is not what you're using to determine that. The timing of the test performed after the balance sheet date, that's not something to consider. Our familiarity with industry trends, no. Relative effectiveness and efficiency, remember we said what? If misstatement is not apparent through a test of details, an analytical procedure would be efficient in that case, and you would use it. Or if the data for a test of details is not available, or if the analytical procedure is not seen to be effective, you would go to a test of detail. Or if the data is not available, then obviously we're only left with the ability to do the analytical procedure. Okay. Which of the following non-financial information would an auditor most likely consider in performing analytical procedures? Okay, good. Square footage of selling space is a piece of non-financial data. Okay, look, your analytic has to be something measurable. How do you measure the objectivity of the audit committee? Turnover of the personnel in the accounting department, that again is something that's going to be very difficult to have a solid base and something comparable to an expectation, right? Management's plans, I don't know how you'd quantify plans. So these don't set them up for analytic. The solid example here is the square footage of selling space. We know what the selling space is, and we can set up a reasonableness check against the sales versus the square footage of selling space for the water bill that we used. And that's non-financial data. Okay, going over to the next question, gross profit has declined. And what happens here? There could be an error if this decline does not seem appropriate for our gross profit. So this is probably a planning level analytic that is causing the auditor to think maybe there's an error there, and as a result, I'm going to probably raise my risk and material misstatement and move to my substantive procedure. I'm probably looking for tested details here to help lower my detection risk. Okay, audit documentation, all right? And when we talk about audit documentation, that is commonly referred to as work papers. What happens? We're sitting here and we have all this evidence we're gathering, but we just can't, have the evidence scattered about our office or, throw it away at the end of the engagement. We're going to have to maintain audit documentation, okay? And it aids the auditor but it also provides a focal point for reviewing of the work. And the expectation is, and when you look, they literally have in the Accountancy Acts and the regulations, codes of professional conduct, and expectation that we will prepare work paper audit documentation that would allow an experienced auditor to understand with no other input, not stapling ourselves to the work papers, with no other input, be able to understand the conclusions that were made, the decisions that were made, the support for the opinion in our audit documentation. So that's how we're going to, if you will, present our evidence, is through audit documentation. Okay, so it will show how we comply with auditing standards, support the basis for our conclusions about our financial statement assertions, demonstrate the underlying accounting records agree and reconcile to the financial statements. That document where I showed you we had the assertions and we made all our decisions about the assertions and then ended up with audit procedures that we were going to do, that could be seen as an example where we will then lead the reader of those financial statements back to the specific documentation of the tests that we performed, both the control test if we did those and the substantive procedures. Okay, so there's going to be, and we already said this, a written audit program. It's going to enable there'll be a written audit program in the audit documentation as part of our audit documentation written audit program, and it will enable a knowledge and experience reviewer to go through and understand the conclusions we reach, the timing, nature, extent, and timing of our procedures, as well as the specific dates, etc., of our work. So when we look, we can have permanent files, we can have current files. Permanent files are items that are going to still be relevant past the current year, you think? Okay, for example, the articles of incorporation of a corporation, long-term debt contracts, these sorts of things are going to be considered to have a longer shelf life, so we call them permanent. Of course, nothing's really permanent, but they do call it a permanent file. Current files pertain to the current year under audit, this year's confirmations, this year's adjusting entries, this year's minutes of meetings, of the board meetings, etc. Okay. Now we'll have a heading, indexing, tick marks. All of these things, guys, are very firm specific. I'm not going to test you on common headings or indexings or tick marks. Whatever firm you're working for, yours are going to be different from the way a GAO would do those. I've seen examples of tick mark like this and that, and I'm like, that has no meaning to me at all. To them, it means everything, okay? And so we don't get into testing of tick marks. Just know that that is often done to indicate some conclusion or procedure that was done by the auditor. Okay, so it's going to be organized. It's going to be the property of the auditor. And under Sarbanes-Oxley, if you willingly destroy work papers, you could be subject to criminal jail time type penalties. And that was because with Arthur Anderson, I think the guy's name was Dave Duncan, the partner, got involved in shredding audit documentation and stuff. That's a no-no. I mean, everybody knows that, I think. Okay. Okay, let's take a look at a couple questions about our audit documents. Permanent files are those that are of a long-term nature. Okay, for example, debt agreements. These other things, you would get these every year, and so they're going to be in the current file. Okay, audit documentation records the results of the auditor's evidence gathered. Procedures when preparing audit documents, the auditor should remember that it's designed to facilitate the review of an experienced auditor. Okay, expectation is that an experienced auditor can come in and review, and the work paper should facilitate that. Okay, good. I'm going to go ahead and tell them to keep my ink annotations. Maybe I can post those slides up for you. But that gives you that are annotated. I'll put these up with this recording that you're obviously seeing, and that gets us through chapter 5. Okay, talking generically about evidence and how evidence is going to support. And again, it's all about the assertions, and I keep saying that. And when we start getting to the actual accounts, cash, accounts receivable, you're going to see how we're really auditing assertions, and we're going to get evidence that supports those assertions. And we're looking for the most persuasive evidence, but we can rely on some less persuasive evidence if we have a good quality of some of the higher levels. Then we don't need as much of some of the lower levels of evidence. If we have less of the higher level, we're going to be leaning more of the lower level. And again, if we have a risk of material misstatement going up, then we're probably going to need more evidence. So those two factors play in to put our evidence, and we talked about the different types of audit evidence: inquiry, inspection, confirmation being external, inspection being auditor direct personal knowledge, inquiry being oral evidence, not as persuasive. Okay, so we had the persuasiveness, then we had the different types of procedures that will generate the different types of evidence, all then documented through our work papers. And we talked obviously about our analytical procedures and how those would be used as well in planning, required final review planning, and we could use them as an analytic. Hopefully going through some of these questions was helpful for you as well. Once you are finished with this, you should get in and look at, I didn't put all the homework and quiz questions here. I put quite a few of them, but not all of them. You should be looking at those. At this point, guys, I would highly recommend that you print all your quizzes. You print all of your homework questions and the solutions you've seen, and you put those in front of you. You have those there, and you start to set aside the 3 hours that you will need for your midterm. Now, the midterm, again, I will make it available just to make sure I've got my dates right, on Friday, September 16th. That will remain available for you until 11:59 on Sunday the 18th. Please don't wait till 9 o'clock on that Sunday to get into your test. Okay, you should set that time aside and be ready to knock that test out. And at 11:59, all of your homework from chapter 1 through 5 and your midterm will be due at that point. And the way you get to that, I said this at the beginning, is you get to that by clicking on right here in Canvas. You click on your assignment. You'll see midterm 1. You click on that. That takes you into Connect, and you were going to work your test. You'll see the midterm there, and you're going to work your test in Connect, and then you can submit it there. If you don't submit it, then Connect will submit it for you. And so you have to sit there and work that test and submit it. Otherwise, Connect will submit it, and they're going to put a 0 for you in the grade book for that. Okay, guys. That's pretty much it. If you have questions, please reach out and let me know how I can help you, and we will talk soon. Good luck on your test, okay?